So you hear about bank stress tests all the time, right? Well, when regulators put a big bank through one, they're really trying to answer one simple but absolutely critical question. If a huge economic crisis hit tomorrow, would this bank actually survive? And to answer that, you have to get to the very heart of how a bank makes its money before everything goes sideways.
Okay, so you might think the first step is to jump right into figuring out which loans might go bad. But nope. Before you even get there, you have to answer something more fundamental. How much cash can the bank's normal, day-to-day business generate even while the economy is in a nosedive? This is where a really important acronym comes into play. And that acronym is PPNR. It stands for Pre-Provision Net Revenue. The easiest way to think about it is like the raw horsepower of the bank's engine. It's all the money coming in, minus all the normal costs of doing business, before the bank has to set aside a single dollar to cover potential bad loans. This number tells you what the bank has to work with. It's its first line of defense in any crisis. So to really get what PPNR is all about, we have to look at a bank's income statement. But we're going to stop at a very specific spot, right before we get to the messy part about setting money aside for loan losses. We are laser-focused on the core, money-making engine of the bank itself.
Now, here's the key thing to remember. PPNR in a stress test isn't just a number from last year's report. Oh no, it is a full-blown forecast. Regulators basically dream up a nightmare economic scenario, unemployment soaring, markets crashing, and then they use models to predict how every single part of a bank's income and expenses will react. It's all about forecasting performance under extreme pressure.
But you can't just model PPNR as one giant single number. That wouldn't work. A bank's earnings are like a really complex machine with tons of different moving parts. So if you want to build a forecast that you can actually trust, you have to take that machine apart piece by piece. And that's exactly what the Federal Reserve's framework does. It breaks PPNR down into, get this, 23 separate components. And all of those fall into three big buckets. You've got net interest income, which is the classic way banks make money on loans, non-interest income, which is all the fees and services, and of course, non-interest expense, which is what it costs to keep the lights on.
And just look at the level of detail we're talking about here. The model doesn't just look at income. It forecasts the interest a bank earns specifically from its loans versus what it gets from holding treasury bonds. It separates the money made from trading in the markets from the service fees on your deposit account. On the expense side, it projects employee salaries separately from rent and maintenance on its buildings. Each one of these things reacts differently in a crisis, so each one needs its own unique forecast.
So how in the world do you model 23 different financial streams during a hypothetical crisis? Well, you can't use the same method for everything, that's for sure. You need a specialized toolkit with exactly the right tool for each specific job.
The Fed's toolkit has three main approaches. The big one, the real workhorse, is panel regression. That's a statistical model that looks for historical relationships, like what happens to investment banking fees when the whole economy shrinks. Then you've got structural models. These act more like super precise calculators for things that have a direct, rules-based connection to the economy. And finally, for the really stable stuff, they use simple non-parametric models, which basically just say the bank's recent performance is the best predictor of its future performance. Let's compare the two most powerful tools here to really see the difference. Panel regression is all about the data. It crunches decades of data from tons of banks to figure out how something like investment banking fees, which totally depend on a healthy economy, are going to react in a recession. A structural model, on the other hand, is perfect for something like the interest expense on a specific type of debt, where the contract literally spells out that the rate is tied to a market benchmark. It's a direct calculation, not a statistical guess.
Okay, that's enough theory. Let's see how this stuff actually works. We're going to zoom in on the single biggest PPNR component for most banks out there, the interest they earn from making loans.
So to forecast the interest income from loans, the Fed pulls out that panel regression model. It's driven by two main economic variables, the short-term interest rate, which they measure with the 3-month Treasury yield, and something called the term spread. That's the difference between long-term and short-term rates. That spread has always been a classic indicator of how profitable banking is.
And there's a really clear economic logic for using these variables. It's not just random math. The Fed's own documentation points it out. The whole model is built to capture how the average interest rate a bank earns on its entire book of loans slowly adjusts as market interest rates go up or down. When the Fed changes rates, it doesn't instantly change every loan. This model captures that slow, gradual adjustment process.
Okay, so we've looked at the what and the how. But if we're going to trust these models, we really need to understand the fundamental assumptions they're built on. These are the ground rules that make the whole system tick.
All right, first up, normalization. To compare a trillion-dollar bank to a $100 billion bank, you have to model their income as a percentage of their assets. It levels the playing field. Second, autoregression. That's a fancy term for a simple idea. A bank's revenue this quarter is probably a really good starting point for predicting its revenue next quarter. Makes sense. Third, fixed effects. The model is smart enough to know that some banks are just naturally better at some things than others because of their business model, and it accounts for that. And finally, this is a big one, constant balances. The model often just assumes the bank doesn't grow or shrink. This lets regulators isolate exactly how the economic crisis itself hits profits.
So why make all these assumptions? Well, it's a trade-off. They make the models simpler to manage, more stable from one year to the next, and, most importantly, they make sure that every single bank is being measured with the same yardstick. It's all about creating a fair, apples-to-apples comparison for the entire banking system.
And that brings us right back to the big picture. PPNR is the foundation. It's the cash that a bank generates from its normal operations that can then be used to absorb the hit from loans that go bad in a crisis. Having a strong PPNR is a bank's first and, frankly, its best defense against failure.
But this whole incredibly complex framework leaves us with a huge, lingering question. Every one of these models is built by looking in the rearview mirror, by studying how bank revenues reacted to crises in the past. In a world with brand new technologies, new kinds of financial products, and new global risks, how good are these historical models at preparing us for a crisis that looks nothing like the ones that came before?